Hello, my dear students. Welcome to Business Studies classes for 12th standard. This is chapter number 9, Financial Management, and we are doing lecture number 3 of this chapter, in which we are going to learn about capital structure with your Jerry sir. So, let's start the video. So, students, today our topic is capital structure. This is lecture number 3 of chapter number 9. Okay, now the name is capital structure. So, the word is coming structure. So, you have seen the structure of your room, as we can determine or as we can define your structure of your room in the terms of length and breadth and height. In the same way, if we have to define the structure of a business capital structure, so we can define it in the proportion of debt and equity. Okay, so on the basis of ownership, the capital of firm can be primarily classified into two sources, that is own sources and borrowed sources. Okay, own means owners fund and borrowed means which you are borrowing from financial institutions. The owners fund can be raised through equity share capital and preference share capital and reserve funds and the retained earnings, whereas borrowed funds can be raised in the form of bonds, loans from banks and other financial institutions, debenture and public deposits. Now, in order to make financial management effective, it is important to decide the proportion of each source carefully. We have to think that how much we should take equity capital, how many we should take debt capital. Now, this makeup or this composition of capital of a business enterprise is known as capital structure. So, capital structure is what? Debt divided by equity. So, the capital structure should be such that which increases the value of equity shares. It means value of the shareholders, or maximizes the wealth of the equity shareholder. That type of capital structure should be called as best capital structure. Now, generally companies use the concept of financial leverage to set up capital structure. Now, what is the meaning of financial leverage? So let's understand through this one. See, as I told you about debt and equity, so just learn more thing about debt and equity. Debt is risky because payment of regular interest on debt is legal obligations. We have to pay the interest on our debt, but equity shareholders are safe securities from company's point of view, as companies has no legal obligations to pay dividend. Okay, now let us understand the financial leverage, as financial leverage is help us to set up the capital structure. So what is financial leverage? Just pay attention on this one. So as you can see here, financial leverage refers to proportion of debt in the overall capital. How much debt is there in overall capital? It shows the financial leverage, debt upon equity. D for debt, E for equity. So with debt fund, companies funds and earnings increases. Now what they are saying? See, they are saying on contrary that if debt fund companies fund, with debt fund companies fund and earning increases. If we are taking more debt, then the earning will increase of the company, because debt is a cheaper source of finance, but it is very risky. Now it means they are saying that what that if we talk about debt, so the risk in debt is high. Okay, risk is high, but the cost is low. In which? In debt. If we talk about equity, so in equity the risk is low, but the cost is high. As I said, the debt is cheaper source of finance, but it is very risky. Okay, more debt will result in increase in earning only when rate of earning of the company, it means rate of investment, should be more than the rate of interest on debt. Now, how it can be that if we take more debt, if we take more borrowing, so it will help in our earning? How it can be? Because we have to pay our debt also, and they are saying if we take more debt, then our the earning of company will be more. How it is possible? They have put one rule also, that the rate of investment or rate of earning should be more than the rate of interest. Now let us understand this with a table. Now, in order to prove that the owners of the company's gain or earning per share is more when debt is involved in the capital structure, we will take following examples. Now, when debt is more, we will earn more. We will try to prove this concept through the three situations. So first situation says that when we are having total capital, how much? Rupees 50 lakh. Just pay attention on this one. We are having, in first situation, we have taken total capital rupees 50 lakh, out of which equity capital is how much? Rupees 50 lakh. The full is what? Equity capital only. There is nil what? Debt. We are having no debt is there. So it means all the capital we have raised through equity capital. It means 5 lakh shares were there, which are of 10 rupees each. So we have raised all capital from equity capital. That time tax rate was 30% per annum, and that time the EBIT stands for earning before interest and tax, means earning before we have paid interest and tax. That is how much? 7 lakh. Okay, so that time total capital was 50 lakh and EBIT was 7 lakh, and that time debt was nil. In second situation we have seen, now total capital is same 50 lakh, but this time with equity capital we have taken debt also. Equity capital rupees 40 lakhs, in which 4 lakh shares of rupees 10 each, and we have taken 10 lakh debt also. It means borrowing. So when debt will come, so what will happen? The interest on debt will also come. So interest on debt we have to pay 10%. Earlier there is no interest on debt. Tax rate was there but no interest on debt, because there was debt was nil. That's why no interest on debt. But this time debt is there 10 lakh. So interest on debt is also there, that is 10% which we have to pay. Okay, now tax rate is same 30% per annum as earlier, and EBIT is also same 7 lakh as earlier. In third situation you can see total capital again same rupees 50 lakh, and this time we have increased the debt value. Earlier we have taken equity capital rupees 50 lakh in first one, full equity capital, then we have taken 40 lakh. This time we are taking equity capital 30 lakh. We are raising capital through equity capital, that is 30. And debt we have increases from 10 lakh to 20 lakh. Now debt increases to 20 lakh, and tax rate same 30%, and interest on debt is also same 10%, and EBIT is also same 7 lakh. Now let us calculate earning per share, it means EPS. Then we will understand that why I said that if more debt will be there, then more earning of the company will be there. It is beneficial for company. Let us understand with this table. Now EBIT means that earning before paying interest and tax was 7 lakh in all the three situations. Just pay attention here. 7 lakh, 7 lakh, 7 lakh. In all three situations we have seen earlier. Now how much interest they have paid? See, in situation first there was no debt, so there was no interest on debt. So it will be nil. But in second situation 10%, third situation 10%. Let's see here. First situation we have not paid any interest because there was no debt, so it was 0. So 7 lakh. So EBT, it means earning before tax. Interest we have paid because interest was no interest was there, so it remains 7 lakh. Second situation, there was a 10% interest was there, okay, on debt. So there was a debt, how much? 1 lakh. How it 1 lakh came? Because 10% we have found on 10 lakh, because 10 lakh was our debt. So when we have find 10% of 10 lakh, it come 1 lakh. So our interest which we have to pay, it is how much? 1 lakh. So after deducting this 1 lakh from 7 lakh, how much come? 6 lakh. This is our earning before tax. Now see, this 1 lakh we don't need to pay to shareholders, but we have to pay it to those people from whom we have borrowed, like financial institutions. Okay. So now how much left? Earning before tax 6 lakh. In situation third, now the debt was 20 lakh. So 10% of 20 lakh, 2 lakh. So 7 minus 2 lakh, it comes 5 lakh. Okay. Earning before tax came 5 lakh. Now you have seen, or maybe you have noticed also, there was what? Tax rate also 30% in each case. So we have to deduct this one also. So now deduct this that tax. Now the balance left 7 lakh. It means EBT, earning before tax. Now we will deduct 30% of EBT. It means 30% of 7 lakh, which will come 2 lakh 10,000. When we subtract this amount, we will get earning after tax 4 lakh 90,000 in first situation. If we talk about second situation, now same tax rate is there, 30% of 6 lakh, which will come 1 lakh 80,000. After subtracting 1 lakh 80,000 from 6 lakh, it left 4 lakh 20,000. In situation third, after subtracting 30% of 5 lakh, how much left? 1 lakh 50,000. So 5 lakh minus 1 lakh 50,000, it left 3 lakh 50,000. It should be 3 lakh 50,000. By mistake they have written 35,000, but it should be 3 lakh 50,000. Now you just pay attention here. In first case there was no debt. So how much tax we have paid? 2 lakh 10,000. How much tax we have paid? 2 lakh 10,000 tax we have paid. It means our more earning went into this. Now when we have taken debt, when we have taken 10 lakh debt, so how much we are paying? Only 1 lakh 80,000 as a tax. So here we have saved our 30,000 rupees. Just pay attention here. When we have taken debt, So we are saving 30%, 30,000 rupees as a tax. We don't need to pay this 30,000 our extra earning to the tax. And if you check third one, situation third, when we have increased our debt from 10 lakh to 20 lakh, so now we have to pay only 1 lakh 50,000. So now if I compare to 2 lakh 10,000, so we are saving 60,000 rupees. Can you imagine how much rupees we are saving now? That's why they said if more debt will be there, so there will be more earning of the company. Okay, now just find out the EPS, earning per share, because after checking this EAT, earning after tax, it is 4 lakh 90, it is 4 lakh 20, it is 3 lakh 50,000. So you are saying, sir, earning after tax is coming more in situation first, this is situation is best. No, we are finding earning per share, how much they are earning at each share, that one we are finding. So see, the total shares were how much? 5 lakh at the rate of 10,000 each. Okay, total shares how much? 5 lakh. We have to find out of this 5 lakh only. So how much earning after tax? 4 lakh 90,000 divided by 5 lakh. Then we will get our EPS. So how much it comes? If we divide this by this, so it comes 0.98. Now if we compare this to this one, where we are having 4 lakh 20,000 divided by 4 lakh. Now why 4 lakh? Because this time how much shares are there? 4 lakh shares in situation second. So we divide by 4 lakh, it comes 1.05, which is more than situation first. And if we check third one, in situation third, there was 3 lakh shares. So 3 lakh 50,000 divided by 3 lakh, so it comes 1.16. So you can see here, this EPS is highest in which one? Situation third, where more debt is there, which shows that more debt means more earning of the company. I hope it is clear to you. Now remember one thing, that statement which I said, that more debt means more earning will be holds true only till rate of earning of capital, or means that when return on investment of the company is more than the rate of interest charged on debt. As we are charging how much? 10% rate of interest. But how much rate of earning? It is more than that rate of interest. That's why it is suitable situation for us. Why? Just check here. EBIT how much? Earning before interest and tax paying. It was 7 lakh. Divided by total investment, how much we have done? 50 lakh. 5 lakh shares of at the rate of 10 rupees each. So how much total investment we have done? 50 lakh. Divided by 50 lakh into 100, it's coming 14%, which is very higher than the what? Our interest rate. Our interest rate was how much? 10% only. So 14% is much more than the 10%, which shows that our rate of return, ROI, rate of investment or rate of return, is much more than the rate of interest. Rate of interest, you can say. Okay, that's why it is suitable situation for us. When more debt will be there, so more interest will be there. Okay, but suppose that if return on investment is less, suppose now there is another case when the return on investment is less than the rate of interest. Return on investment is less than the rate of interest. Then what will happen? Then the equity shareholders will lose by including more debt. Now if we include more debt, then it will be a loss for us. Just check, same thing is there, 50,000. Now just check here. I will not explain full because already I have explained. Just check about this one. How much total rate of earnings there? 3 lakh only. Earlier it was 7 lakh. If we found out our rate of interest or rate of you can return on investment, if we find here, so it's coming 6% only, which is much less than the 10%, which was our interest rate. Okay, so in this case, if we are having more debt, so it will be a condition for loss for us, for loss for the company. Here also you can see 6%, which is less than the 10%. Okay, so here interest rate is more than the rate of return. Okay, so in this case, if we are including more debt, so it will be a condition for loss for the company. Even they have explained with this table. Okay, situation 1, situation 2, situation 3, when the you can say that rate of return is less than the interest rate, then we will be in loss. So then in that case, if more debt will be there, so what will happen? More loss will be there. So we can say, in other words, we can say that during the boom period, when the market is on high, when the boom period is there, we must have more of debt and less of equity shares in capital structure. Okay, but when the market is in depression, so during depression, when income or return is less, when our income is less, return is coming less, In that case, we should have more of equity and less of debt in the capital structure. So this is should be the composition of capital structure. So I hope it is clear to you today, students. At last, I just want to say, be safe and God bless you all.